Well, it's Monday morning, and I wanted to jump on here real quick because on the front page of the Financial Times today, First Brands declared bankruptcy. Now, for the first time, we're really going to get a factual, we'll say, understanding of what's going on here and maybe get an idea of how big this actually is. So you can see the article here. They said they filed for bankruptcy and it's threatening multi-billion dollars in losses. So I want you to remember on our last video, they came out and said, hey, the problem's somewhere between $5 and $10 billion and the company has $800 million in cash. And then on Friday, a bank came in and took the $800 million in cash when there's in transit. Okay, so we don't know who that is just yet, but we're going to take a guess, of course, all right? But in the filing today, in the third paragraph, you can read it's estimated that there's between $10 and $50 billion in liabilities, and they put the assets somewhere between $1 and $10 billion. So they say it's fueled by concerns of its off-balance sheet finance, which we discussed in detail. And then First Brands previously told lenders it had $5.9 billion in long-term debt in March against $1 billion in cash. Remember those numbers. And indicates that there are billions more in opaque financing linked to its invoices and inventory. So I want you to be aware of something, what we're going to talk about today with the SBEs and the SIVs. There's two different kinds of financing, totally different between the invoices and the inventory. So when they sell something, there's an invoice on it, they borrow against the invoice too. They're not messing around, okay? And in the last paragraph here, they say they have $8 billion in secured corporate debt and financing backed by inventory, okay? But we already know it's not backed by inventory. Now, excuse me. Now, the paragraph we're interested here is the second one. All right, so they list several specialist investment firms as creditors with exposure to First Brand's so-called factoring, a form of invoice financing, including an asset management arm of the U.S. bank Jefferies. So a couple things here. One, I don't think it's any accident that Jefferies is mentioned here, okay? And they are in another article described as the agent for First Brands and this inventory financing. And as we said in a previous video about this, is that they can be sued. It's kind of, remember what happened with CS First Boston. Credit Suisse went down over Huang, cost $10 billion. A couple firms got picked off, but the biggest one was Credit Suisse, and they ended up going bankrupt. And why were they called in? Because they were the agent selling the Huang paper to other banks, so they were on the hook for it. So just real quick, factoring is an invoice financing. It's a process where the business sells the accounts receivable. Okay, so First Brand sells the account receivables to a third party called a factor, in this case, Jefferies, for immediate cash. This allows the businesses to improve cash flow, getting quick access to funds, and pay their invoices in full on standard terms of 30, 60, 90 days, okay? So that's factoring, and that's how Jefferies is involved. So think about it, Jeffrey gets the product and they sell it to people, and we don't know what, but we now know that the liabilities could be as high as $50 billion, and frankly, we don't know if that's the top, okay? Now, they mentioned in the first paragraph here last Friday that the owner of James of First Brands has 5 SPEs, and 4 of them declared bankruptcy on Friday. And by the way, the trading in the paper for First Brands, all this inventory, all this factoring and everything, they said, quote unquote, it was chaotic. And for traders to say that, it must have been wild, absolutely wild. And so the last 2 things here, paragraph, refer to people that we do know that are involved in First Brands in relation to the inventory debt, okay? Which is really the critical part. So we tried to address this yesterday with the covenant lights and all this other stuff, and you say, How can people not see what's going on? Don't they do their due diligence? Well, look what was on the front page of the Financial Times today, and I'm going to put out a challenge here. Anybody that can come in and read this and tell me what's going on, I think you need a job with a major global financial firm. Here are the legal structures of First Brand. Okay? So we don't know where the SBEs are and all this, but this is showing debt and so forth, and who owns it, who guarantees it. Is it inventory guarantees, a guarantor, whatever it is. This is what it looks like when someone wrote it down and said, hey, let's see what's going on here. Now this author, this was printed this morning, okay? So he went through the bankruptcy document, and he says, the debt of this table sums to over $8 billion. Remember what we said before. They said they only have $5.9 billion in debt in March. Now, just on this page alone, which they say does not to include financing arrangements linked to customer and supplier invoices, and some providers named as unsecured creditors. There could be billions of dollars more in factoring, reverse factoring arrangements at play here. So, now we know what the term counterparty exposure actually means. It means someone sells you something and it ain't any good and you have counterparty exposure. So the exposure to these guys and these inventory things and to Jeffries, I think is, well, it's at least billions. Now, is it somewhere between $1 and $50 billion, okay? And you have to remember something we talked about, there's leverage, and people were kind of thrown off on this. You have to remember something. You can't look at a trade that a bank does just as a trade with the bank. I own this stock, right? Did I margin the stock? No, I own it. I own 1 million shares of this stock. But the bank is leveraged 15 times. Or if you're a hedge fund, you're leveraged 50 times, all right? So it doesn't matter when you say, I own this stock. You don't own it. The bank or the hedge fund itself is levered up 50 times, 50, okay? So if you lose $1 billion, that means that this is capital. So you think about what goes on. You have your investments on top, and underneath you have your capital, and the capital is leveraged 50 times up. Now, if you lose $1 billion, you're losing $1 billion worth of the capital. That means to make up that capital, either you raise $1 billion or you sell $50 billion worth of securities to get back in alignment, okay? So, I'm not saying this is bigger than big. I am saying that this thing is an example of Wall Street not watching their P's and Q's. So, what do you think? Tell me in the comments. Thank you for following, and thank you for listening.